Well, yeah, thanks for having me and all of our future-minded colleagues and attendees. Before I go into this presentation, I'm going to take a slight detour because it is 2023. And if we're not using GPT, language learning models, then we're not doing it right yet. So let's briefly, I'm going to share my screen and I will do. All right. Okay, so I created a couple months ago, trying to get ahead on this GPT stuff, an AI representation of myself, loose draft, couldn't be improved, but I wanted to test the technology. So I gave it this prompt. I haven't tested this yet, but rather than me giving the introduction, I want to have AI Drago give the introduction to the speech, and let's see what happens.
As the world continues to rapidly evolve and shift, it is more important than ever to have a solid understanding of the businesses driving progress forward. My book, What Does This Company Do? Understanding a Business and Its Risks, provides readers with a comprehensive qualitative framework for doing just that. Join me as we delve into the complex world of business models and the risks they bring in the pursuit of progress.
There you have it. Not bad. Maybe next time AI Drago will give the whole presentation. But here we go. Let's dive in. So I wrote this book, What Does This Company Do? Understanding a Business and Its Risks, when I was an analyst on Wall Street looking at companies. Initially, it was targeted towards investors trying to make informed decisions on choosing the winners from the losers. But frankly, it's useful from the perspective of an entrepreneur if you're trying to pitch your company and create a compelling narrative, as well as pitch your company to clients. So let's dive in. These days, as many of us do, I think about life in the pre-COVID era and the post-COVID era. And so the pre-COVID me had this Wall Street career. I was an investor. Invested in credit securities, leveraged loans, high yield bonds, distressed debt. And I was fortunately given the task of looking at about 35 different industries. And I select some companies you might be familiar with. There's also smaller companies as well, but looking at like technology, financial services, retailers, power plants, telecom businesses, food companies. It was an amazing experience, but the challenges it provided is how could I possibly communicate a level of expertise on these different industries when I'm not a specialist? How can you be a generalist that's competent? And I realized I needed some kind of framework to make sense of all this complexity. And so I figured there would be a lot of materials out there, finance education from different, career professionals, but this is what was missing in the industry. It's the framework I wish I had qualitatively. But first, to give you more context, post-COVID, I went to Chicago Booth, got my MBA, and I pivoted into the startup space and venture capital, including with some early stage and late stage venture capital. So still investing, but then also operating some startups, including my own on the software side. So back on Wall Street, what would my day look like if there's an active deal? You'd go to one of these fancy hotels where the CEO, CFO of these big companies give their presentation, represented here. And they also give you some nice food and treats. I don't think that happens anymore as much. And then I would have to synthesize the information they gave me to a memo, and I come back and I pitch it to my investment committee internally. So I have to make a translation of the things I hear and how it fits our objectives, like we all do in our jobs. And so ultimately, this boils down to storytelling. The company presents their story, their packaged pitch. We have a story about how we need to manage the assets and the people who have entrusted us to manage those assets, that we could do it responsibly. So you need to synchronize the stories and see if there's a match. I think a lot of the stories with the company you can decompose simply in these types of questions. What happened with the company? Revenues were up 10%. Why did it happen? Cause and effect. And then what's going to happen next? Of course, here we are in the Futurist Expo. That's one of the more relevant questions. We're all trying to forecast what's going to happen next so we can predict and anticipate the environment to come. And then if you want to get even more specific, you can even ask the counterfactual question of, well, what could have happened instead? I think that is the key edge that an analyst or thinker can do, is look at what happened in history and imagine, well, if the factors change slightly, what would have we seen occur instead? And I think a lot of the innovation and the true insight comes from that question. And then, of course, if we have influence in the outcome, what can we do now to affect what happens next? And then finally, we may have our view of the company, but as investors or people who are pitching our company, we recognize there's other people's opinions that matter as far as the pricing. So what would the average investor or the market looking at this company think regarding the same questions of what's happened and what's going to happen? The simple mental model, this is 101. I mean, we could tell, a first grader this, but for any company, like, we need to have the revenue, the cost, and the profit in our head. Sounds simple, but it's easy for us to forget when we start thinking about these grand visions of companies. Like, we got to bring it down to the basics again. And what are the drivers that contribute to the revenue, the cost, and the profit? Of course, with revenue, most companies, we should think about the units of the product or the service. If it's a service, it could be measured in terms of hours or other contracts. And the volume of that, very simple, price times quantity. And then for cost, the most important thing is understanding which costs are fixed regardless of the volume of the business, and which costs are variable. And again, most of you listening to this is like basics, but trust me, it's going to get, it builds up from there. And so behind this understanding of revenues and costs, we're really just talking about, again, with our story, how and why the revenues and costs move. At the end of the day, that's what anyone in a conversation cares about. You want to understand the movement of these variables. So whatever we're pitching, whatever we're discussing, we're trying to get a better understanding of what's the trajectory of revenues and costs and why. We could also think about this, Econ 101, intersection of supply and demand, as in what do people want and what we're able to provide. These are anchoring points. Again, if we're trying to synthesize and simplify what we're talking about, always go back to here's what people want, here's how we can provide it. And what's the degree of match between what we're providing and what people want? Now, another idea is when we look at these movements of revenue, cost, or any element, how do you know that you have analyzed enough on the movement? Well, here's what I would say. Address these 4 factors. Every element has a direction, so it's either getting positive or negative. There's a degree, so we need to have a story about the severity of the impact. So whatever we're talking about, is it big or is it minor in the directionally up or down? Now, the dispersion of our estimate, because we all know, thinking about the future, the thing we forecast is going to happen is the thing that's not going to happen with precision, right? There's always a range of possibilities. So any story that we tell should incorporate that dispersion of our estimate, the range of, worst case scenario, base case, optimistic case. And then the story isn't complete unless we have a dependency array, cause and effect. So here's the dispersion of things that can happen. We need to have a story about what's going to affect that change of forecast. And if you have these factors, you could feel pretty good about the story that you're telling. And minor point, I chose, perhaps by coincidence, all these elements start with the letter D. My name, my initials are DDD. It could be a subconscious thing, but here's the 4 Ds for you. And I provide an example. I think you understand. But again, revenue goes up 20% because we had a new contract. If things were different, it could have been worse. That's like an example of what you could say. So let's get into some of the frameworks of what does this company do now that this kind of overall context is set. The 2 big takeaways, I'd say, are spectrums and like the problem solution framework. In my book, there are about over 30 spectrums. This is how the book is organized. Once the context is set up, there are 30 spectrums. So qualitatively, if you take your company or whatever company you're looking at, you can analyze it through these 30 spectrums. What do I mean by spectrums? This is applicable to thinking in general. This is not just about business. This is not about this topic. This is just about thinking in general. I'm passionate about analyzing how we think. I love playing chess, as some of you may know. So what do I mean by spectrums? Well, anytime we make a judgment and we say, oh, well, that's good, that's a good company, or ooh, that's bad, that's a terrible thing that happened. Spectrums is an acknowledgement that there's nothing good or bad in isolation, particularly when it comes to things like business. It's all relative to the comparison set. You might have an investment that's bad, but if it was your only option, well, then maybe that's good. So every aspect of a company can be plotted along these different spectrums. And so you can compare almost like a personality test where, I'm in the 100th percentile or 50th percentile or 10th percentile. You can take a company through all these spectrums and plot it out. And these spectrums, what's nice is they transcend the industry classifications. So as I mentioned before, I had the challenge of like 35 different industries. How do I talk in a cohesive, holistic way about the portfolio I would look after? It's because these spectrums, I can compare the food company to the power company to the chemical company using the spectrums. How do you form a spectrum? You first establish the upper bound and the lower bound. So wherever the company is, you imagine what would it look like if I turn the dial up all the way to 100% and amplified that, or if I turn it down to 0. So then I have the extreme scenarios, and then I can see where the company or the factor lies within those extremes. And I know this sounds theoretical, and I promise I'll give you some examples, but that's how we think about the spectrums. And then, problem and solution. The staples of any company, we need to just come back to, well, what problem is the company trying to solve? And does it involve a product or a service? This sounds super basic, but if you look at the 10K or SEC financials of some of these companies, it's or just the company websites. As you know, you'll see these generic descriptions. We are a technology solutions provider for the healthcare industry. And you're like, well, what's that, right? So we need to have a concrete visual in our head of what's happening. And with regards to concrete visuals, here's like one framework. The question is, what's the threshold where you can look at yourself and say, yeah, I know what that company does. I understand the business and its risks. Well, let's start with this type of image here. So the person with the hat is the business provider. And of course, they have a product or service, which we'll need to understand the full supply chain, starting from the raw materials to the intermediate processing to the end distribution. And of course, that sounds like manufacturing, but any industry, you can think about that from raw materials to final transaction. And then, of course, we need to understand the flow of money coming from the consumer to the business owner and provider. And the handshake represents the nature of the contract, right? I mean, of course, if we're retail, the contract is just us swiping the credit card and there's an implied agreement. But, other businesses, we have long-term contracts with certain clauses. And so we need to have a firm understanding on that. And I actually categorize the spectrums based on these buckets. So we have spectrums that are related to the revenues of a company, spectrums related to the products and the services, to the expenses, and then general macro considerations. So with the product and service, how do we know if something's a product or a service? Normally, I would ask people, like I've presented similar topics at a university, and I'd like to hear what people say. But I'll just tell you how I phrase it for now. A product, in my mind, is when you're converting or combining existing raw materials or things into a new thing, right? So we have, on this earth, we have resources. So anytime you're taking that raw resource and converting it to something else, like, okay, here's my phone. That would be a product. For intangible goods, so even now in like Web3, and we're talking about NFTs and we have tokens and all that stuff, you can still use the framework. Perhaps though you think of the raw materials as inner subjective myths. I've written more about that on my Substack, and of course, this was popularized by I believe CryptoPunk 6259, but and then the Homo Sapiens book. Intersubjective myth are these invisible truths that we all collectively agree to, right? Like, actually, I don't want to go too far into that, but I encourage you to read more about that. And then a product typically involves a transfer of ownership, right? So the company owns the product, you purchase it from them, you are now the owner. Service, I would differentiate as something that happens when you change the state of an existing thing, when you're doing something to an object. So if I were to go get a haircut, the service, right, that they are cutting my hair, the guy's changing the state of me, or like a landscaping company is changing the state of the lawn. They're not transferring an ownership of an object. You're changing the state. So typically the customer already owns the thing, and then your service is you're changing the state of that thing. And so here's like a table of contents on the spectrums related to product and services. I'll just pick one example here to give you a sense. So one spectrum, and you see a lot of companies frame their offerings in the context of, is it a do-it-yourself offering or is it a do-it-for-me? This is explicit for things like an auto parts provider, like Advanced Auto Parts, AutoZone, O'Reilly. It's based on a used car market, right? So it's a do-it-yourself. Instead of me being the mechanic, instead of me going to the mechanic, if I'm a do-it-yourself, I'm going to do it myself. However, even when it's obvious, there are other industries where you can use this spectrum. Like, what if we applied this to the food industry? Sure. Do-it-yourself on one extreme is literally I'm planting the seeds, I'm farming, I'm completely creating the food using nature and serving it, preparing it, etc. And then of course we have grocery stores where the farming is done, I can get the fresh produce, but then I still have to prepare the meal, I have to cook it, I have to drive, transport the goods, right? Grocery delivery, well, now the transport is coming to my front door, but I still have to prepare the food. Meal kits, someone has curated the food selection, so I don't have to make the decision of choosing and selecting. Restaurants, you have the curation and the prep, so someone is actually cooking the food and they've sourced ingredients. And then of course, like a Grubhub, where I don't even have to transport myself to the food. The prepared food comes directly to me. So all of a sudden, we've conceptualized a do-it-yourself to do-it-for-me spectrum in food. And again, you can do that for any industry. And this is useful when you start looking at statistics like eating at home versus eating away. And a spectrum like this provides the insight of the consumer mindset of, is it more of a do-it-yourself impulse, a do-it-yourself impulse, or are people migrating towards do-it-for-me, right? Revenue spectrum. So here's some spectrums for revenue. Let me give you one example. I'd say one of the most common and important spectrums and topics I'd have to do is when I was an analyst is how visible is this revenue? Is this the type of business where customer says they want something and now all of a sudden we're like, okay, let's make this, let's provide it. And there's not much of a heads up, like made to order. Or is this contractually guaranteed where we're locked in, recurring revenue for the next 3 years, have high visibility, right? And I give some examples here of industries that that would represent, but let's keep moving. We have revenues, but of course we have expenses. What's an example of a expense spectrum? I think capital intensity is an important one. So for this business, do we need a lot of hard assets, big upfront investment in order to produce and offer the solution that we want to provide? Or is it minimal in, as far as the equipment load? I mean, now you have a lemonade stand, here's the picture, because of the service we provide. Pretty self-explanatory, right? You have on one extreme the huge factories and big intensive production processes. On the other, you have like a people business that doesn't require too much fixed assets. So what are the trade-offs? When there's a lot of hard assets, you're going to have more capex compared to opex. So when you're making a decision as an investor, or again, if you're trying to create your own business model for a company, this is where you start thinking about that. And the other factor is the smoothness of the scalability and the operating leverage. So what do I mean by that? With the capital intensive business, if you want revenues to grow, it's going to happen in like a step function, because I have this factory, I've maxed out capacity, I need a new factory or the new servers to make it happen. For cost for the OpEx businesses, revenue and cost scale together. And then finally, recovery value is important. So if the business fails, if I have a lot of hard assets, there's still some value I can recoup from the business. If there's no assets, then my downside case is worse. So those are some of the trade-offs. Of course, there's more than that. Some macro themes, and I want to get to Q&A, so I'll go through this one a little more quickly. Cyclicality. We have the cyclical businesses that move with the economy, the ones that are counter-cyclical that actually improve, like the trading firms, like the market makers, Jane Street, Citadel Securities, Hudson River, and non-cyclical business that are completely independent, more or less, from the broader economy. I have a framework that you could take your company or the company you're analyzing with as well that kind of summarizes the steps, if you like sequence and order. But I want to move on to Q&A. And then also, if you want to talk like GPT and all that, I've done some podcasts and radio things about that. Would love to exchange feedback and thoughts, because I do think that we really need to incorporate this into our businesses, not only to survive, to thrive in success, but also to survive. I don't think it's a hyped up thing that people are trendy and then won't care about. I do think we're at the cusp of a change of an era. And I'm sure many of you would agree. But either way, I welcome a robust conversation for our remaining minutes. Thank you.